realtors will distribute and share that with the people who are attending right now. And I believe the session is being recorded as well. So hopefully, if you miss anything or if you actually have any questions regarding the slides, feel free to let me know at the very end. By typing in your Q&A, by typing in your questions in the Q&A sessions, and we'll go over some of those um, discussions later on. So let's get started. I know we have a long discussions ahead, so I will start off with an economic outlook first. Let me show my screen and share my slide. You guys can see my slides, right? Perfect. So let's get started. I know we have a lot of things to cover. So now, as I mentioned, at the very beginning, we have a very different year this year. This is a very challenging year because of what happened in the public health arena. At the beginning of the year, everything started off very normal. And then, well, I shouldn't say that because in China, we started having coronavirus at the end of last year. And I think some of you might have attended to at my presentation at the Global Real Estate Forum at the beginning of the year. I think it's in February. And I think at that time, I briefly mentioned about coronavirus. I said, yes, we have a coronavirus going on. And at that time, we actually did not have a name. We don't have the COVID-19 name, but coronavirus was in China and it was spreading. And I think in the presentation that I did earlier this year, I said, I used the swine flu as a comparison to see what the impact is going to be for coronavirus, whether it's going to have a significant impact on the economy for the US as well as the global economy. At that time, I believe I said, the impact could be it could be minimal. It may have a little bit of impact, but it could be minimal. I remember someone asked me also about the stock market, whether it's going to have an impact on the stock market as well. And I said, it's probably not going to be a significant impact based on, what we have seen from the swine flu, some of the diseases that we have seen in the past. We've never had anything like this. So at that time, I said, it's probably going to be not going to be a significant impact. And of course, I was wrong. I was very wrong because of, the impact that we actually have from the coronavirus. And I think I probably, and even though I'm wrong, I've been wrong, I'll have to say I'm not the only one. I think a lot of economists probably got it wrong as well. So if you take a look at the coronavirus, that's the major wild card. That's the main factor that's going to affect, that's affecting this year and next year. So it's safe to say that we definitely need to look at, the coronavirus as a factor and take a look at what the condition currently is, with the coronavirus. So I'm going to start off with the coronavirus update. Now I got these numbers from the state of California website. They update it on a daily basis, and here's what we have right now for California. If you take a look at these slides, these numbers, you'll see, number of cases that we have right now is over 900,000 as of, actually it's updated as of yesterday. So the date was actually a little off. Apologize for that at the very bottom. It's actually updated as of yesterday. We have over 900,000 cases. The number of new cases that we have every day. Now, if you take a look at the slide on the graph on the left-hand side, you'll see that it actually on a daily basis, we have 4,500, which is not a small number. But if you look at that number, which is right here, that number is actually way below, what we had in July and August. Now, we did have a shutdown. Remember, we had a shutdown, a painful shutdown, in late March, April, and May that actually created, a lot of a loss of economic activity. And at that time, we were able to, but at the same time, because of the shutdown, we were able to keep things kind of calm. We were able to keep the number of cases low, but we actually reopened in around mid-May, early June, and the number of cases spiked up, in California. At one point, it went close to 10,000. But in the last couple months or so, we were able to climb it down a little bit. Now we are going into the flu season in the next month or 2 months or so. We're going into the flu season, and you probably have heard on the news already. Um, Going into the flu season probably will lead to a surge in the coronavirus, and we have already seen some spikes in other states. California started actually rising a little bit. Take a look at the number right here. We started seeing that number of cases start going up. 4,500 is a very high number compared to what we had 2-3 weeks ago. I think it was below 3,000. So we got to be very careful. We got to make sure that we are keeping this under contained by practicing our social distancing measure. Because if we don't, we're going to lead to more deaths. Take a look at the number of deaths in the middle. So far in California, we have about 17,500 total deaths, and each day in the last few days or so, the number actually started rising again by about 75 new deaths every day. At one point, I think we were down to about 30. So this is something we definitely need to be concerned about, and make sure that we're practicing what we're supposed to do, putting our masks on, and doing social distancing. Now, the other number that you want to take a look at is the positivity rate. The positivity rate is the number of people who get infected. There is a threshold. I think for California and for probably some of the states, 8% is the threshold. That is, if it's 8% and below, we're okay with the economy or the state open up. But if it passes that number or close to that number, then we might have to shut down again. We did get very close to that number, I think, in July, mid-July or so, 7.5, 7.5, 7.6% positivity rate. But then we have come down to about 3% because of everyone putting in their effort. But you can see that number actually started rising also. I think at one point we got down to 2.5%. Now it's 3%. So just need to be concerned, because that is the wild card. That is the factor that affects a lot of things. Now, what has the coronavirus has already done to the economy? That's very important, because we need to know about the background of the economy to understand how it might affect the housing market. So the economy, you might have heard, this morning we have a release. We have some numbers released. The third quarter GDP, the gross domestic product, that measures the economic activity, just released this morning. And if you haven't been paying attention to that particular measure, you take a look at the stock market right now. Stock market actually, at least earlier this morning, it was up. I think it was up maybe close to 1% for the NASDAQ, and for Dow Jones, it was up maybe about 0.5% earlier. I'm not sure about now, but it was up early because of some encouraging news. Why? Because the economy actually bounced back. Take a look at the slide on the screen. On the right-hand side, right here, you see those orange bars. Those orange bars is actually below the 0%. For the first quarter, when we had the shutdown, remember the shutdown was what? The lockdown started in late March, right? Maybe in, I think March 19th or so. So for 2 weeks in the first quarter, which is from January through March, we actually had a shutdown. This 2-week shutdown actually led to the economy going down, the economic activity going down by about 5% in the first quarter. That's actually a pretty, a steep decline compared to some of the quarters that we have seen in the past 10 years or so. But that was only a prelude. If you take a look at the second quarter, what happened in the second quarter? It dropped a little bit more than 31%. So that's very significant, because of what happened. We shut down and we started locking down in March, and then we extended, we had the lockdown for about 6 weeks, 7 weeks or so, right? For the whole April, and then May, half of May at least, we started shutting down, and we lost a lot of economic activity. That's significant. Now, if you want to compare, if you want to get an idea of what 31.4% is, that's the biggest drop that we have had since the Great Depression, since 1940s-ish or so. Now, but here's the good news. The good news is this morning, we saw a bounce back in the third quarter from July through September. This is the number we saw a jump of 33.1%. That's encouraging, right? And that's one of the reasons why I think, we're seeing some positive news in the stock market. When if you've been paying attention to the stock market, I think for the last week or so, a few days or so, we have been seeing some decline in the stock indices. So a little bit of encouraging news pushed the market up a little bit. 33.1% also is a record number. We have never had a 33.1% increase in the GDP. That's significant. Now, you may ask, so, with a significant jump in the GDP in the third quarter, that's great. So we are back to normal, right? Well, not necessarily. First, we knew that it's going to be big because we look at retail sales, and I'll go for some retail sales number. We look at retail sales in July, August, and September. They look very positive. They look like, they're back to normal, but there are other sectors that actually are not, doing as well. With the 33.1%, you have to remember at the beginning of the year before the pandemic, we started off at a higher level. Then we dropped to by 5%, and then we drop another 31%. So this jump of 33.1% that we experienced in the third quarter actually is a jump from a lower level. So to make it clear, compared to last year at the same time, we're still down by about 3%. Compared to the peak before the pandemic, we're still down by about 3.5%. That's where we're at right now. So now a lot of, and I said, it's anticipated because if you look at the different economic predictions and different projections from Bank of the West, UCLA, even NAR, Wells Fargo, they all predicted third quarter to be a pretty solid third quarter. Ranging from 20% NAR to about 31% of Fannie Mae, and so on and so forth. Everyone predicted that it's going to be a very, very solid, sharp increase in the third quarter. And because of what? Because of what I mentioned earlier. People have been paying attention to retail sales. Retail sales is a big part. For the GDP, you probably might have heard, GDP has a lot of different components. The economic activities include what we spend, right? We spend on, buying groceries, we spend online. Many of you probably participated in Amazon Prime Day. So we buy things online. Those are consumer spending. Consumer spending is a big part of the GDP. It makes up about 65 to 70%. So that's a big part of the GDP. So if consumer spending goes up, then GDP usually goes up. Now, and retail sales is a big part of consumer spending, not everything, but a big part of the consumer spending. So if retail sales actually goes up, then consumer spending should go up, right? So take a look at these numbers, these bars. Now the dark blue line here, that's retail sales, total retail sales. And if you look at this number that we got from the September data, this number is higher than what we saw early part of the year in January and February. So if you just base on these numbers, it looks like, well, yes, we have already surpassed the pre-pandemic level. That's great. We don't have to worry too much. But here's the thing: if you break it down a little bit now, and I said, retail sales is a big part, but it's not the whole part of consumer spending. There are other parts which I'll go over shortly. But if you just break down consumer retail sales, you see, if you look at retail sales excluding food services and drinking places, namely just restaurants and bars, if you exclude that, if you're just looking at how people buy online or how people actually buy from grocery stores, it is a higher number compared to the 2019 average. It's 4% or 5% higher as of August. But what about the other part? The restaurants and drinking places. We all know that, some of you may have seen my slide that shows open tables. I should have put the slide in. There is a slide that I use that shows the activities of opentables.com, which is a website that actually help people make reservations for restaurants. That little slide shows you that economic activity or the reservation activity for opentables.com stood down by about 20-30% because we're also practicing social distancing because we want to make sure that we are safe and healthy. And so if you go to a restaurant right now, the number of people who attend, who dine at a restaurant is much less than before, right? Because they're keeping the capacity low. And for that reason, look at the red line here. Retail sales, which includes the food and drinking places, dropped significantly in April when we had the shutdown by about 53%. And even after the bounce back that we're experiencing right now, it is still down by about 15% or so. So there are definitely some industries, there are some sectors that are not doing very well. Retail is doing better compared to before, but here are some of the sectors that not doing very well. If you look at the stock prices of some of these companies, you get an idea what sectors are actually doing well. Now we're using Zoom right now, right? So Zoom obviously is a company that actually has grown significantly. Why? The Zoom is one company that actually help people work from home and hence their ability to get in touch with people. So companies that allows people to enhance people's ability to access things remotely or enhance people's ability to avoid in-person contacts are actually doing okay. Take a look at these companies. Amazon, you can buy things online. Amazon stocks have gone up 55% as of September. Netflix, we can't go to theaters anymore, right? So Netflix, we stream online programs, 43% increase. Grubhub, obviously, we can order groceries. We can actually order food and have people delivered to us. So those actually have increased. So what has gone down? What companies have gone down? You probably could imagine. We're not traveling, right? That's the reason why we're doing Zoom. And even if we could travel, there are probably spacing between seats. So what happened? Hotel industry, travel industries, that includes American Airlines. American Airlines dropped. Hotel industries also dropped. Cruising, people are not cruising anymore. Dropped 71% as far as the stock price is concerned. What about theme parks? We can't go to theme parks anymore. We can't go to Disneyland. That's why those actually dropped. And also Boeing, that actually manufactured airplane, dropped as well. Dining industries, Darton restaurants also dropped, by 22% or so. And also another one that I neglected to talk about. We can't really go to the gym and to work out, right? So what happened? Planet Fitness dropped as well. But on the other hand, Peloton increased significantly. So there are some industries that are still struggling. A lot of industries, and it's big industries. The tourism industry is struggling a lot, and we're not going to see any increase or any improvement until we actually either get used to the current public health environment, or until we have a vaccine or a treatment that will prevent the spreading of the virus. So that's going to take some time. Now, because of that reason, a lot of people got laid off. And take a look at the unemployment rate. The unemployment rate at one point in April and May actually shot up for the U.S. actually shot up quite significantly by close to 15% at one point, and then it started actually slowing down. Now, for the state as a whole, for California, it's even worse. There is a reason why California actually is performing worse than other states, because California is a state that actually, and that we have a lot of people traveling to. We have a lot of tourism here from outside of the country, as well as from other states. So obviously, when we have when people can travel and visit some of the touristy spots, that's going to lead to a decline. But we also have a lot of restaurants here in California. Those, unfortunately, a lot of them have to be either shut down or have to practice social distancing. Now, the unemployment situation has improved. This morning, other than the GDP number that was released, we also have a number that was released on jobless claim, the number of people who file claims for unemployment. That number also shows an encouraging sign it continued to improve, but that number continued to stay at a high level. The number continued to stay above last recession's peak. And last recessions, many of you know how bad it was. People were concerned at that time, of course. But the housing market was the sectors that actually collapsed and led to the significant decline in economic activity. But this is even worse because of if you look at it by the number, it's actually worse because there are a lot of uncertainties that's not preventable by economic measure. You have to actually go with the public health guidelines. So unemployment continued to stay at a very high level. It improved lately. It's down to about 8% for the nation as a whole, but for the state, it's still above 11%. And many economists believe that that number is not going to, it's going to continue to improve, but we're not going to be back to the pre-pandemic level until maybe 2023. Take a look at the number here. The recovery is definitely happening, but look at what happened for the first couple months when we had the shutdown. It dropped by about, at the state level, we dropped by about 21, 22 million jobs. That's a lot of jobs. And then we started recovering in May, and we continued to recover. But the recovery is very, very slow. We had a significant surge in June, but so far we have only recovered about a third of it. Same for California. If you look at the next slide, I'll show you this next, and you'll see get a better sense. As of September, week dropped in California, dropped about 2.6 million jobs, and we recovered by about 994,000. That still left us with 1.6 million jobs, and those jobs, like I said, probably in the hotel industry, in the tourism, in the casino. Casino has not recovered yet. Theaters, we're not going to movie theaters because of we don't want to congregate and spread the virus. And you probably know, some of you are sport fans, we're not going to a basketball or a baseball game, even though both teams, Lakers as well as Dodgers, won this year. We weren't able to actually see that in person, and it may not happen for a while. It may not happen for at least another few months or so. So what about the housing market? I mean, I gave you the background on the economy. It looks like, yes, we have a significant downturn, picking up some steam right now, but it's probably going to take a little bit of time for it to recover. What about the housing market? Now, for the housing market, I think I probably spoke to some of you throughout the last few months or so, and you might have heard. If you asked me 6 months ago, I would say, the market is there are a lot of uncertainties out there. We are going to have a down year. If you look at the April number, look at the May number for sales, May number didn't tank, but April number tanked, significantly. We dropped 50% of sales, but things actually turn around a little bit. If you look at, if 6 months ago I tell you that, oh, by the end of the year we're going to be fine, we're going to be up 20%, you probably will wonder, what are you talking about, right? So this is the latest statistics that we have that we released for September. This is for the state as a whole, and you can get a snapshot of this from the C.A.R. website as well, and I can show you later on where you can get some of these numbers or some of these slides. If you take a look at the latest number, the September numbers, actually they look quite encouraging. What I have here is right in the middle right here, that's sales level. That's annualized sales number of existing single family home. If you look at the state as a whole, and many of you probably experience it yourself, that we have been seeing some quite competitive market out there. We have been seeing some sales out there in the last couple months or so. People started catching up and started actually coming back to the market and try to buy, to take advantage of the low interest rates. Interest rate is right now below 3%, right? In general, I think 30-year fixed rate, below 3% right now. Some may even be able to lock in with a 2.5%, depending on their credits and all that stuff. But because of the low interest rate environment, a favorable lending environment, take a look at what happened to sales. Compared to last year, we're actually up 21%, 21.2% to be exact. The month before that, in August, we were up about 17 or 18%. I can't remember the exact number. So we actually have covered, recovered some ground. This number, this 489,590, that's the highest sales level that we have had in more than 10 years. So we are seeing some record sales numbers, and because of what we have seen in the last couple months, even though we're still down compared to last year for the first 9 months of the year, if you look at the first 9 months, we were down quite a bit in the first half of the year, but the last 3 months actually started recovering. For the first half of the year, and up until June, we were down by about 13%. So last 3 months, we really made up some ground, because then if you include the last 3 months a lot for the whole year, then we're only down by about 3.7%. There's a chance that we actually may be catching up and even be virtually flat compared to last year. And I'll show you those forecasts in a minute. So we're only down by about 4%. Now, still down, but we're still only down by 4%. At the same time, the constraint that we have, that many of you might have experienced, is the supply side. The supply side, I think some sellers are still unwilling to put their house up on the market for different reasons. Some sellers are also buyers, right? So they might have a tough time actually competing in the market right now, trying to figure out, where to live. And at the same time, they may not necessarily want to put their house on the market if they actually cannot get a hold of a property themselves. So they're not putting it up on the market at the same time. But the other part of it also is, correct me if I'm wrong, some sellers are still very concerned about letting people in, walk into their property. There are a lot of people who are doing virtual tours now, but realtors are doing virtual tours, but there are some still don't want to do virtual tours. They still don't want people to get into their house. And maybe that's the reason why, we are seeing some drop off in inventory. Take a look at this number. If you look at this number right here, unsold inventory index, months of inventory, is only 2 months. Now, usually, we're supposedly in the off season, right? September is not supposed to be the home buying season. Home buying season is usually from maybe April to July, maybe stretching to August. Going into September, that's usually not the traditional home buying season. And the reason why I think we're getting more activities, part of it is, of course, people are catching up, like I said, but also low interest rate environment, but maybe also because kids may not have to go to school. People don't necessarily have to right away decide where they want to live for their kids' schooling system a couple months ago. They now can actually decide now, because kids are actually learning virtually online. Many of them, not every one of them. So that's the reason why we might be seeing low inventory, because we have very high demand, but not enough active listings being put on the market. And what happened when you have not enough supply but a high demand? You see a significant surge in price, right? Take a look at the price tag here. The median price, the statewide median price that we have right now, it is about 17 or 18% above last year's level. The state median price is 712,000, which is significantly higher than what we saw in the last couple months, or a couple months ago, a few months ago. So for many sellers, many homeowners, that's encouraging, but also keep in mind the increase in home price probably has something to do with mix of sales, the change in mix of sales. I'll explain that a little bit more in a minute. For sales, it has been gaining momentum. You've heard about a V-shaped recovery and all that stuff, right? Take a look at this, improvement that we saw from May of this year and now. It's definitely bounced back quite significantly. We have been gaining some momentum, and we haven't seen this momentum, for the last 10 years. And we truly, in the housing market, we truly have, and at least in the state of California, we truly are experiencing a V-shaped recovery. Maybe not the economy, but we are seeing some really nice bounce back. It looks like a V to me, right? Bounce back, sales, closed sales up 21.2%. And it's not just the single family homes, but also the condo as well. Now, I want to show you this slide as well, because the improvement in sales, the increase in housing demand is not equal across different price segments though. If you look at the different price segments, we break it down by price segments. This is sales in the 0 to 200, 0 to 300, 300 to 4, and so on and so forth. You can see the upper price segments, sales tend to be a lot higher on a year-over-year basis compared to last year. Why are we seeing that trend? Well, for a couple of reasons. First, notice that yes, the lowest price segments actually dropped 25%, but all the other segments actually increased by more than 10%, double-digit increase. Very encouraging. And there are reasons that I can give you for why the lowest price segment continue to suffer. The lowest price segment continue to suffer for quite a few reasons. We actually have been seeing some decline at the low end even before the pandemic. And the reason is we don't have enough affordable homes. We continue to have the lowest level of supply at the lowest price segment. But also, the other part of it is I show you in the economy, for the economic outlook, I show you some numbers. I show you that different industries actually suffer differently, right? For some industries, they're actually doing fine. For other industries, they're suffering. The industries that suffer the most, as I mentioned, are those industries that actually maybe in the service sectors, those industries that actually requires person-to-person contact, right? Dining, restaurants, bars, theaters, those requires person-to-person interactions. And a lot of the lower income workers are actually in that sectors. So the economy, the economic downturn actually affect the lower income workers a bit more this time, because many of them are actually in the person-to-person contact industry, and because they tend to be the low income households tend to purchase houses that are more in the lower price segments. Their demand are being suppressed because of the economic disasters that actually hit them a lot harder. And that's why in that demand in the housing demand in that sectors actually got a bigger blow compared to other sectors. Other sectors are doing better because of that reason. And of course, we're seeing significant growth in the upper price segments in 2 million and so. And 2 million above, there are a lot of homes in the Bay Area as well. So because of that reason, I think I mentioned earlier about mix of sales. We are seeing more sales in a higher end, and that's one of the reasons actually that pull up, the median price, home prices a little bit. So it's not just on every single home has appreciated in price, but also we have a change in the mix of sales. We have more home sales at the high end. And we have been seeing that trend actually starting in June or July. You can see that this blue line actually has been above, blue and the orange line have been above, the dotted line for quite some time for the last few months or so. And what are these blue lines and the orange line? That represents the increase in sales for 2 million and 1 million and up, or 1 to 2 million and 2 million and up. So you can definitely see that sector, those price ranges are actually doing better. Now, looking forward a little bit, you wonder, whether we can continue this momentum, right? The momentum, if you look at pending sales, open escrow sales, it looks like, we probably will see some momentum going forward in October and maybe in November. We have some weekly numbers as well, which I don't have a slide here. But if you look at the September pending sales, it's up quite a bit. It's 26.3%. So that suggests to me that, in October, we probably will see a double-digit increase in sales, closed sales as well. What about November? Weekly numbers that we've been gathering also suggest some double-digit increase in pending sales. So that's going to show in November that we're going to see some improvement compared to last year. So it's safe to say we probably will have a pretty good year. Now, the momentum that we have been seeing in the last few weeks has actually surprised us a little bit, and that's why we actually made some adjustment to our forecast that we presented at the C.A.R. meeting at the Leslie's forecast earlier, and I'll show you that number. But what about consumer sentiment? If the sales numbers gives you some idea of where things are statistically, but what about the sentiment of the consumers? Buyers and sellers, we do a research on a regular basis, on a monthly basis, and we ask them whether it is a good time to buy or a good time to sell. And 28% of those consumers, potential buyers, said, yeah, it's a pretty good time to buy. Now, this is not a huge number, and it is actually below last month's level. But if you compare that to a year ago, it's higher. It's 6% higher. That suggests to me that buyers are still considering buying. They still want to buy, and sellers think it's a good time to sell too. But it's not. It's also dipped a little bit compared to the previous month, but it's higher than the previous year. Many of them believe it's a good time to sell, but the question is whether some of them actually will sell because they may be tied up with their current home and they can't really find a home to move to, and that's why some of them have not been posting their listings or their property on the MLS. With interest rate at a very, very low level, we have a record low level right now, for interest rates. That's one of the primary reason why buyers are so upbeat about, they want to own a home. Now, there are other reasons as well. But the record low rates really motivated buyers. We have a rates, an average 30-year fixed rate below 3%, provided by us or reported to us by Freddie Mac. Freddie Mac have been keeping track of those numbers since I think the beginning of 1970s or so, and it's the lowest number that we have had. Now, whether we are going to go lower, it's really hard to say. I think we probably have maybe close to the bottom, if not already at the bottom, but we're at 2.89%. Next month, we probably will have a lower number, but only by a little bit. So interest rate is one reason. The other reason that I mentioned is people are catching up. With the shutdown in April and in May, many people actually put off their plan of buying and selling. We asked in our survey also whether people are putting it off. Now, first-time buyers, 83% said they have to actually put out their plan during the time when they had a pandemic shutdown, and sellers, 80% said they are putting it off. And that's one of the reasons why I think we're seeing continuous demand in October, and maybe even extending to November. December, it's hard to say. We'll find out. And because of that low rates and very tight supply that I showed you earlier, take a look at the market. You probably know it in person. 60%, close to 60% at the state level, at least 60% of the sales actually have multiple offers, and an average, those we have about 4.8 offers per sale, which is really high. I think a couple years ago the number was about 3%, average of 3 multiple offers. So that's significantly higher than what we have seen in the past. And I talk about supply, and I show you the supply, months of supply earlier. It's only 2 months, but take a look at what happened here, and you get a better sense, because these are actual listings numbers, total number of active listings. It shows that active listings continue to decline. We have been declining. It's below so the blue bars below that 0% line means we're below last year's level, and we have been below last year's level by quite a bit. This month by 48.4%, and we have been below by about 40% for the last 4 or 5 months. So that's significant. With only about 60% of the level of supply, but a lot higher demand. That's why you're going to see some increase in prices. Here's another slide that shows you how different they are, comparing the current month of supply to last year we were at 3.6 months. And with tight supply, obviously, we're going to see the properties flying off the shelf, right? Right now, a property still in the market on average by about 11 days, significantly below last year's level. And here's the slide that shows you, where we're at in terms of prices: 712,000, which is 17.6% above last year's level. Now, this number also is interesting. I know I don't have the month-to-month historical number, but I can tell you, in August and in July, we were actually growing by 6% on a month-to-month basis. The fact that it's actually dipped down to 0.8% suggests that we were actually slowing down in terms of median price. So we might already have seen this highest price of the year, and we probably won't hit another high. The price growth, as I mentioned, is also accelerating, is also increasing, just like sales, with a V-shaped recovery. But like the sales, I want to break it down by different price segments. Some segments are actually doing better compared to other segments. I know the breakdown is a little different. Just look at this. Look at it this way: for 0 to 20%, these are the percentile. For the lowest percentile, which represents maybe 0 to 400,000 price range, the sales actually increased by close to 20%. All the other actually increased closely by about 20%, 22% or so. But the highest price segments, this is probably the 80th to the 100th percentile. That's probably represents 1.5 million and up. That's actually increasing even more significantly, 31, 32%. And it has been doing so for the last few months or so. So now I mentioned about low mortgage rates, right? Yes, we have low mortgage rates that usually motivate people to buy, and that's great. And but here's the questions: whether that momentum is going to carry forward. If we continue to see mortgage payment below last year's level, people know that it cost them less compared to last year to buy the same home. That's great. And take a look at this light blue line. Has been below that 0% for quite some time, since early March of 2019. Continue to stay below, but the last couple months, because of significant increase in price, at least in the statewide median price, that number actually is now above last year's level. So usually what happens is when we have mortgage payment above last year's level, we started seeing some decline. I don't have the slide here, but we started seeing some decline in sales a few months afterward. Now this time it may not be different, because the increase in mortgage payment may be due to mix of sales rather than actual increase. So, but I do believe that there will be some slowdown in the next few months or so. So let's talk a little bit about the regional market, and I'm going to just give you some city level slides before we wrap up this first half, and then we'll move on to international buyers after the break. But let me give you some regional numbers as well. Now, regional by regional, I'm going to show you some Southern California numbers. I'm going to focus on LA as well. This is the Southern California snapshot. Southern California represents about 55% of all sales. So it's not a surprise that, we are also seeing 20+% increase on a year-over-year basis. For the first 9 months now, we are looking at, below last year by about 5%. And we also have significant increase in price as well, 15.2%. Months of inventory, very low, 2.1 months, and a time on market, only 10 days. So very significant decline in time on market. I'm breaking it down by county. Here we have sales by county: LA, Orange, Riverside, San Bernardino, San Diego, and Ventura. Take a look at LA, or actually before you take a look at LA itself, take a look at the year-over-year percent change for individual county. Every single county actually is doing very well. Compared to last year, they're all increasing by double digit, but some of them actually are increasing by 30%. Orange County, San Diego, and Ventura. They're all increasing by 30%. Um, LA actually is the county that has the lowest increase on a year-over-year basis. Um, I think part of it has to do with international buyers, and I'll explain a little bit later in the second half of the session. But if you look at the international, the county for the 9 months, the year-to-date number gives you a sense of how we're doing for the whole year, for the first 9 months of the year. All of them, all counties, are actually doing pretty well with a decline from last year, but only by a single digit, except for LA County. LA County is still in the red by about 10%. But look at Orange County, San Bernardino, and San Diego. They're very close to, these three, Riverside, San Bernardino, San Diego, they're very close to matching last year's number. A decline. There are some areas, for whatever reason, that's not actually doing very well for LA, but I think we will have some catch up. And again, I single out LA here with the red line. LA actually has been increasing in terms of pending sales for the last few months. In fact, this upcoming months, in September, it shows that LA County's pending sales actually increased by about 20% ish or so. That means in October and maybe even November, we probably will see some healthy increase in LA. But not only LA, many counties as well, with Orange County actually leading the number of pending sales increase from last year. So we will have a pretty good rest of the year for Southern California. Supply remained an issue at a county level. LA dropped about 45%, but every single county really dropped compared to last year. With the more affordable county like Riverside and San Bernardino actually dropping quite a bit. San Bernardino actually dropped 66%. Now, Ventura also dropped, but I think part of the reason why we're seeing Ventura decline could be some technical glitch. We're still looking into it, but there might be some issues with some of the MLS number of Ventura. For the price, with a significant drop in price, LA also increased significantly in terms of price, but not just LA. All the counties increased in price significantly, with many of them showing double-digit increase. Now, I'm going to show you a few city slides to wrap up this first half of the sessions. I'll show you where to actually get some of these slides. Now, we actually create city level slides for members to use that you can actually download, grab, and then send it to your clients. These are some of the city level slides that give you a snapshot of the LA cities in the San Gabriel Valley. I grabbed a few that might be relevant to the association for Arcadia Association. So Arcadia obviously gives you a snapshot of where we are at price-wise. We're a little bit down compared to last year for this month, for the month of September, but sales actually improved, and you can see active listings for all the cities that I will show continue to decline at a pretty steep level. So Arcadia dropped in price but increased in sales with active listing down. El Monte actually up quite a bit in terms of median price with sales down by about 20%. Now, this number is very, very small, so there might be some fluctuation in terms of observations. Monrovia up 50% in terms of sales, but price also increased quite significantly. Take a look at the sales to list price ratio also. They're actually, this shows how competitive the market is. We're seeing some outbidding in Monrovia with a 1.4% increase compared to list price. And Pasadena also. Pasadena increase in price, increase in sales, also a 2.2% increase from list price. Temple City also show an increase in sales and price. Look at how low the time of market is. Only 9 days for Temple City. Again, because of tight supply and active listings. And well, I think I kind of wrap up the economic and housing market overview in the first half of the sessions. So maybe it's a good time to take a break. But before we do that, let me show you where you can get some of those slides that I just used. Let me show you my screen. You're still seeing my my PowerPoint, but give me a second. Let me show you the screen where you can actually the web page where you can download some of the statistics. Give me 1 second. And you can actually do it yourself and share some of those statistics with your client. My computer is stuck for now. Give me a second. Let me do this. I mean, I think it's slowing down right now for my computer. Let me do this. Let me pull it up. And when we come back from the break, I can show you where to get some of those slides, some of those city level slides. Maybe we should break for another, for about 10 minutes or so. Come back maybe at around 11:07. All right, let's do that. Most people are, right? I'll give it another minute or so. Screen. This is a page, and I'll show you where you'll find it. Go to the C.A.R. website. When you go to the C.A.R. main page, click on Industry 360. Once you click on Industry 360, let me see if I can do it right now. Hopefully it won't get stuck. So Industry 360, yeah, so go to the main page, go to Industry 360. You'll see a market data page. Once you see the market data page, on the right-hand side, take a look at the shareable and interactive report. Click on Housing Market Overview. It will take you to the screen. This is the housing market overview where you can actually download a lot of information. Now, if you scroll down to the page where the dashboard is, you will see a little dashboard that allows you to select a different county. Go to the drop-down box here. It'll allow you to select Alameda, Butte County, Calaveras. Let's select LA for now. And you can download the slide just like what you saw earlier by clicking one of these buttons. The PowerPoint, the PPT is the PowerPoint slide. That's the slide that I showed you earlier. You can download it in Instagram format, and you can download it as a one-pager PDF format. Now, this is county level. If you scroll down a little further, once you select LA County, it will give you a list of cities. These are the list of cities that you can download right now, Acadia being one of them, and Burbank and all these other cities. So you can download it. Once you download it, it will actually give you, it will take you to another link, which is, let me just try one and show you. Let's do Acadia. If you click on this Facebook PowerPoint format, once you click here, let me see, you may not see my screen anymore. You may not see the same screen anymore. Just give me 1 second. Actually, you are seeing the same screen. You will see this pop up. This direct you to a page or a location where you can download that particular slide. Simply click on download and you'll be able to download that city specific slide. Want to give it a try, later on. We put this up every month after our press release, maybe about a day later after our press release. You can go in there, download a shareable item. Like I said, you can share with your clients. You can feel free to send it to your clients, and it gives you a snapshot of the city. So, and of course, if you have any questions, feel free to send me an email. I'll have my email at the very end of the slide deck, but let me give it to you now. It's oscarw@car.org. So it's oscarw@car.org. Okay. Let's get started again. Let's go back to my presentation. Second, let's continue on. Let's get back to our international buyers. And I just explained to you, I just kind of went over the economic outlook. Let me blow this up. Economic outlook. I gave you the background information about where we were at right now, in terms of our economy and where we're at, for the housing market. But of course, we're in a global RE committee. We want to take a look at international buyers. We want to take a look at also the global market to see if there are any opportunities, or whether the coronavirus situations affecting affecting our clients internationally, as well as affecting other countries as well. So let's take a look at international buyers. Now, unfortunately, I have to admit, the international buyers segment here, a lot of the information that I have is information I gathered from NAR. NAR collect their information from their international buyers or foreign buyers survey. And that survey actually was conducted before the coronavirus. They usually conducted from April to March, a whole year level. And of course, were not able to cover that period of time when we actually have in the coronavirus. But it actually gives you an idea of what trend, the foreign buyers trends have been behaving before the coronavirus situations. And I'll explain. I'll show you some additional slides that show some additional information about the buying activity of international buyers during the period of time when we have the coronavirus. So let's start off with international buyers. Um, that NAR provides, information that NAR provides us. This is from a report, called the International or Foreign Buyers Transactions in the U.S. And it shows you, gives you an idea. This particular slide shows you an idea of how many realtors actually work with a foreign buyer in the past year or so. Now you can see at the peak, we had 35%, that was in 2015, 35% of members of realtors actually work with a foreign buyers at some point. That's the peak, 35%, one third, more than one third. But then that number started declining, and it really started declining starting in 2018. It dropped down to 23%, 20%, and 19% for this year, earlier this year. Now, one of the reasons why we are seeing some drop off, a couple reasons, actually, I should say. One reason is, of course, home prices in California and for the nation as a whole has climbed up a little bit. Our economy has done a better job compared to a few years ago. And so there are more domestic buyers, people focusing on people who are buying domestically. But also there has been, in terms of relationship with US and China, there has been some tension, on trade that actually prevent things from happening. And of course, many of you know who have dealt with Chinese buyers, there has been a control on outflow of money, from China flowing into the U.S. And that actually might, or not just U.S., but to other countries, that actually prevented some activities, real estate activities, to continue on because they have problem getting money outside of the country. So let's take a look at a little bit more detail. Take a look at some sales numbers and see. Now, I said earlier in the first slide that fewer realtors are working with foreign buyers, and we can see that in actual transactions. If you look at the slide on the graph on the left-hand side, shows the dollar volume of foreign buyers for all foreign buyers as well as for the top 5 in $1 billion. You can see for China, for example, it started off in 2010 at a low level. It started ramping up, and at the peak in 2017, it was 3 times as high as what it was in 2010. But the last few years started actually dipping back down. 2020, we're at the same similar level as what we were at in 2010 for China. Now, this doesn't take into account coronavirus at all. This is just at the beginning of this year. But other countries actually dipped as well, continue to drop. Canada, for example, while Canada actually increased, but if you take a look at Mexico, also dropped. India actually increased, but still, far below what it was in 2017 and 2018. Colombia actually is one of the, it's never been in the top 5. The other, it used to be UK. UK used to be one of the top 5, but it dropped off, and from the top 5 this year. Colombia actually increased slightly from last year. But all in all, if you take a look at all foreign buyers, it actually dipped. Take a look at how different the numbers are. In 2017, the dollar volume was 153,000. It's dropped down to 74, less than half. Now, you might ask, is it because of people buying fewer units, or is it because of price? Let's examine a little bit. Look at the right-hand side column. Obviously, for Chinese buyers, we have dropped off quite a bit. Last year, it was close to 20,000 units being bought by Chinese buyers, dropped to 18.4, 18,400. But look at how it compares to 2017 and 2018. We're less than half, of number of units being bought by Chinese buyers. But it's not just Chinese buyers. Canadian buyers also dropped. Same for Mexican foreign buyers and Indian buyers as well. Like I said, in Colombia, Colombian buyers actually have increased, And UK, I don't have that number right here, so it probably dropped, and that's the reason why it dropped off the top 5. But overall, if you look at how it compares to 2 years ago for all foreign buyers, they dipped from by about 40% overall. So number of units probably have gone down, but also what about price? Are they buying more affordable price houses, and is that why the dollar volume dropped? Well, not exactly. Actually, many of them, if you look at all foreign buyers, the number actually increased. The price, the purchase price actually increased from 280 to 314. So that's actually the highest number in the last 10 years. I don't have data going back before 2010, but that's a very high number compared to the last few years. Some in the top 5 foreign buyers categories, some actually are buying more affordable housing. Chinese buyers down from 454 to 449. It's a little below last year. Canadian buyers actually a little bit above. Mexican buyers above. Indian buyers above. Colombian buyers actually below. So it's primarily because they're buying fewer properties, not so much because of the purchase price. And of course, tight supply is another reason. Some international buyers were not able to buy because they cannot find a property. Now, whether it is because in the price range or they just couldn't find one, 50% said that's the main reason that they couldn't buy, that they didn't buy because they couldn't find a property. The cost of the properties made up 39%. Financing, they can't move their money. 25% said they can't move. They were not able to move the money. And of course, there are other reasons as well: immigration laws, property taxes, exchange rates, all sort of reasons. But the main reason is difficulty in finding a property, which many of us have the same problem too for domestic buyers, right? Um, Now, for the statistics I show you, as I mentioned, they're from NAR. So they're not California specific. And NAR asked the questions of what the major destination is for these for these foreign buyers. And California continued to be on top of the list. For Canadian buyers, many of them, Florida is their the top destination, but California remains a second at 19%. Said they're buying in California. Chinese buyers, obviously, we have a lot of Chinese buyers buying in LA, buying in the Bay Area and San Francisco, and some of the other counties in LA County or Southern California. Of course, San Gabriel Valley is a big is the top destination where you see a lot of Chinese buyers, foreign buyers. Indian buyers also buying in California. Many of them are in the Bay Area as well. Mexican buyers, 12%. Texas and Florida remain their top destination. And for Colombia and Brazil, California actually is not on the top of the list. I don't have total foreign buyers here, but at least for the top 5, we see a lot of people interested in California. So let's take a look at the California numbers. We do a survey also on a yearly basis, and this year we sent out the survey in late July to try to capture some information, at the during the coronavirus shutdown period, and we saw that number, our number, also has come down quite significantly. International buyers at one point in 2013 made up about 8% of total home sales, but that number has continued to go down in the last few years. It's gone down to about 3.84% in 2019, but this year really dropped down to below 2%. Again, because of, at the beginning of the year, trade tension, but also this year is a year that people have a tough time. Foreign buyers have a tough time actually buying overseas, right? Not necessarily because they can't see it online. They can do virtual tours. Some of them are still getting used to it. But many of them want to travel here to take a look at the environment first, but obviously that's not happening. A lot of people are not traveling to the US, and so we're not seeing as many foreign buyers in the last few months or so. That is probably going to continue on for the next few months or so, as long as we have restrictions on travels, as long as we have coronavirus situation. So we may actually continue to see some slowdown in international buying activity. That might be one of the reasons why in some areas in the San Gabriel Valley, and you can correct me if I'm wrong, that some areas in the San Gabriel Valleys, we might see some weaker demand because we're lacking the foreign buyers activities. If you look at Chinese buyers, which makes up a big portion of the foreign buyers, they continue to make up the top the 30% of all foreign buyers in California. 32% in 2020, 33% 2019 of the foreign buyers are Chinese buyers from Hong Kong, from China, from mainland China, and of course from Taiwan, and Mexico and India were the third and the second and the third. With all buyers, all foreign buyers dropping, obviously, even though Chinese buyers are still the top, the main primary foreign buyers, the number still goes down quite dramatically. Now, let's get back to the NAR numbers. Let's take a look at the nation as a whole as well. What are foreign buyers actually buying the property and using them for? Many of them, you probably know, they're using it for as their secondary residence. Some of them are buying, the property for their kids, depending on, but also depending on whether the foreign buyers is coming from Canada or from China. Now, before we look at the top 5, let's take a look at overall. Many of them are buying it for as vacation home. And now some of those may have to compete with some of the domestic buyers, because you might have seen in our reports before that some of the vacation properties in Rim of the World and Lake Tahoe, they're being competed because people are actually moving over there because now they can actually work from home. If you look at vacation home, it still makes up about 15% of the property, but the main thing is still they're using it as a primary residence. Some of them are using it as a primary residence. I think maybe some foreign buyers are buying it for their kids. Their kids are staying here and maybe taking studying here as well. So they're using it as primarily using it as primary residence. Let's break it down by individual, the top 5, and take a look. If you look at Canadian buyers, many Canadian buyers are buying home here primarily because they want it as a vacation home. So the destination that they want to buy is a little different. They may be buying it in, like I said, Tahoe or some other areas, Palm Spring maybe. But for Chinese buyers, many Chinese buyers, 48%, are buying it for primary residence. That's why we're seeing a lot of activities in Temple City, in Arcadia, and maybe Rosemead, where we see a lot of activities. Now, with some decline in foreign buyers' activities in those cities, obviously it's going to have an impact. I think that's the reason why earlier part of the year, we saw some decline in sales in those areas. And in India, and for Indian buyer, 77% actually purchase it as a primary residence. Most of them, most of the other top 5 also are buying it as a primary residence. And the location properties. So I gave you the intended use of property, and this give you an idea of where they're buying. Now, it's been proven for the last 10 years or so. Many of them continue to buy at a suburban area. Now this time, again, this does not account for the coronavirus outbreak situation. So it may change next year, but a lot of people are still buying in the suburban areas. I would not be surprised next year if the resort areas sales actually start showing a little bit more. Now, many of them are actually, many foreign buyers are buying it, like I said, for their kids, So it may not necessarily make that big of a difference for the coronavirus when people can work from home, but we'll find out next year. For Canadian buyers, not a surprise because they're buying it as a vacation home. So 26% actually bought in a resort area. The other top 5, they don't have that many resort areas. Mainly, they're buying in suburban. For the Colombian buyers, they're actually buying in rural areas, 60% of them. So let's take a look at, give you a brief update of the international bars. Let's take a look at, the global market. First, I'll give you a very brief 2-3 slides of, what the economy is like at the global level. So, and then I'm going to show you how the global housing market looks like, in the last few months or so, and what we can expect in the next couple months or so before we go to, the projections and outlook and forecasts of the housing market for the U.S. and for California. So let's take a look at the global market first. At the global level, I think I mentioned the coronavirus is not just confined to U.S. It's a global disaster. It caused a significant impact economically as well as public health concerns for many countries. But for the economy, take a look at what happened in the last 30 years or so. This chart shows you during that year how many countries actually have an expansion, how many countries actually have an economic contractions. During the Great Recessions year in 2008, 2009, how the number of countries that actually have a contractions was roughly about 60% or so. About 60% or so. This blue line represents contractions. So 60% of the countries have contracted economically. But compared to what we are experiencing right now, it paled because it affected almost every single country. 90% of the countries around the world actually experience or will experience contractions in an economic downturn in 2020. That's how serious it is. With a shutdown, with a lockdown, that's going to happen. And let me give you some actual numbers for the advanced economies as well as for the emerging economies. You can see the global economic output, it is going to be down by 4.4%. That's actually one of the biggest that we have seen for quite some time, and I'll show you the chart. But it's going to bounce back in 2021 with a 5.2% increase. For the advanced economies, that includes US, some of the Euro countries, Japan, UK, it's going to actually dip by about 5.8%. Now, this may not be consistent with what we report and what NAR report, but I want to show you this number as well. Basically, every country is dropping quite a bit. US is actually dropping not as much as the other countries. And these numbers were updated just recently, in early part of this month. So, they're pretty updated. And all of them are dipping, with Italy and Spain dropping by double digit. UK also close to double digit, because I think they also have to be concerned about the Brexit issues. But 2021, everyone is going to bounce back. Maybe not as much. Some of the countries are actually not bouncing as much. US bouncing back with 3.1%, but the EU, the European countries, are actually bouncing a little bit more solidly. UK also by 6%. So safe to say, next year we probably will have a better outlook. Still behind, what we had in pre-pandemic. What about the other countries, emerging markets and developing economies? For China, we actually already saw some improvement in economic activity. I think they released their GDP report a few weeks ago. In 2020, we believe they're going to increase by about 2%. Now, compared to what we had before, they usually increase by 6%, 6.5%, right? Now, if you believe those numbers, then they're actually scaling back by 2%, but still a growth. Other countries are actually not doing as well. South Africa actually is going to drop by 8%, Mexico by 9%. So overall, India is going to drop by 10.3%. Now, if I quickly go back, you can take a look at. Give me 1 second. Let me show you this chart again. This chart again show you, the economy, the coronavirus is spreading quite significantly. The bigger the bubble, of course, the bigger the cases. I mentioned India earlier. India actually is showing significant spread. or high number of cases, and that's the reason why you're seeing some slowdown in economic activity in India. Let's go back to that chart. So next year, of course, every single country will be bouncing back, and assuming that we're not going to have a second wave. And like I said, the whole world is dropping, and in terms of economic activity, the drop in economic activity in 2020 is the biggest that we have seen since the Great Depression in 1940s, 1950s. It's going to bounce back, but still, that's a significant drop. What about the housing market? For the global housing market, because of the drop, there are some effects. Now, I only have data through June, so this probably doesn't reflect in what happens in the last 3 months. As I mentioned, U.S. actually improved quite a bit in the last 3 months because of low interest rates. I believe we're seeing some improvement in other countries as well, probably more so in Asian countries, but UK, Spain, some of the European countries, they continue to have a little bit of a struggle. So in terms of home sales in those countries may not be as growing as fast as what we saw in the US. Australia also is, I think, struggling a little bit. So we may not actually see a significant increase in sales in those countries. But US is actually leading the world with some significant increase because of low interest rates. But China also have already bounced back. Low interest rate definitely, encourage people, motivate buyers to buy. It's operated a little differently, here in the U.S. compared to some of the other countries. But you can see, as far as price is concerned, there are still a lot of countries that's showing some increase in price. Now, here, this chart is reported as some numbers reported by Reuters. It's a poll that actually talked to maybe about 100 analysts. That shows you different countries' home prices. If you look at these polls, the June number is depicted in, so they survey their analysts in June and also in September. So the blue number here is the June number, the orange number, that's the September number. And they also show the worst case scenario. But let's focus on, the median. Obviously, people are actually a little bit more optimistic. In the U.S., for example, you see that there is an increase in terms of the price. They believe it's going to go up by 4%. I believe it's going to be a little bit more for the U.S. But other countries are actually doing better as well. UK, a few months ago, it was predicted to have a down in terms of price. Now, a lot of people think it's going to be an up. Canada as well, increased by 6% instead of 1.5%. Even the worst case scenario for Canada, it's up 2%. Now, Australia, like I said, is an area that might have a little bit of overprice before, so it's actually down by 4.5% this year. Same for India, but China also started showing some improvement by about 5%. So a lot of places are actually showing increase in home prices. And if you look at this chart here, if we hone in into specific cities, many cities are actually influenced by low rates. We have one of the record low rates, as I mentioned, as many of the central government, like ourselves, the Federal Reserve, keep rates down at a very low level. Other companies or other central banks are actually keeping their rates low so that they can continue to have their economy to recover. And many cities or many areas are actually experiencing some increase in price. Now, for us, for San Francisco and LA, based on these UBS numbers, they're saying that the San Francisco and LA counties prices are actually a little overvalued. From 0.5 to 1.5, that's overvalued. Now, but it's not at a bubble level yet. Some of the areas are actually at a bubble level, like Toronto. It's actually prices at a very, very high level. Amsterdam, Paris, some of these areas are actually very, very high in terms of Hong Kong has a very high number. Now, there's a little bit, it's hard to compare and see, what the trends are without showing some historical numbers. So let me show you some historical numbers. These are basically the same numbers, but I'm showing you 2018 and 2019 numbers as well. So you can see if it's red, then it's very bubblish. If it's orange, that means it's a little overvalued. So if you look at LA, that's according to the UBS, we actually have been getting overvalued for the last 3 years or so. For San Francisco, same thing. It's been overvalued a little bit in the last 3 years or so. But some areas are actually just started getting a little bit more, publish, if you may use that word, the Zurich, for example. So you can say, because of low interest rates, we started seeing a little bit more overpricing in some of those major cities. Boston is still very fair valued if someone wants to invest, in a city outside of California. But the low rates are actually, kind of pushing, home prices up for at the global level. So at the global level, we're seeing sales actually start recovering a little bit, in major cities. But prices also have been a little, in some areas are actually quite overpriced, depending on which cities you're referring to. The major cities are actually a little overpriced. Um, but what about the U.S.? Let's take a look at the U.S. And let's take a look at California. Um, Before we talk about the housing market, obviously the outlook will cover the economic background. We want to see if the economy is going to get better before we can decide whether the housing market is going to get better. So let's take a look, because if the housing market, if the economy is actually getting better, most of the time we will be getting better, but at the same time we need to be concerned about whether interest rate will start rising. So let's take a look at the economic recovery. Let's take a look at the outlook and see where we will be in the next few months and in 2021. Many of you have seen this, have heard of it, maybe not have seen this chart, but there have been a lot of different recoveries. I mentioned about a V-shaped recovery, right? For the economy, when it has a V-shaped recovery, which usually it means we have a significant drop in one quarter or a short period of time, and then it bounced back very sharply. Some people earlier, and some economists earlier part of the pandemic said, we might actually have a V-shaped recovery, if the government actually did something by putting in stimulus package, we will probably see a significant increase. Well, that's probably not going to happen. We may actually experience a U-shape or swoosh shape, which means it's going to take a little bit of time for it to recover. Maybe a few months or actually a year or two to recover. We definitely don't want to see a W shape, that is a double dip. We may, if we actually experience a pandemic, another second wave increase. And we certainly don't want to see L shape, that is economy dip but never recover. So where are we? What shape are we looking at? Well, there's another shape that you might have heard of. It's called a K-shaped recovery. That is what I described before. Some areas, some industries are actually doing better, and they're on the way to recovery. If you take a look at the tech industry, the retail industries, software industries, they dipped, but they're actually bouncing back because people can work from home. People can actually conduct their activities at home. So their employers do not have to lay them off and fire them. But there are sectors that are in dire situations. They're still struggling. There's no near-term solution until we get a vaccine. So the industries that requires person-to-person contact, still suffering. It may actually take some time, and they actually may have to lay more people off. So travel industry, entertainment industry, the hospitality industries, that is going to continue to suffer. That's why it's a K-shape, because it takes some sectors are growing, some sectors are actually not doing as well. And because of that reason, we actually project that the economy, with strong growth in the third quarter, we probably will see some bounce back in the fourth quarter, but maybe not as big a bounce as we thought it would be. It's going to be a moderate single percent increase in the fourth quarter for the GDP, and with that, we will probably end up this year in 2020 with a GDP growth rate of negative 3.6%. Then we're going to bounce back with a 4.2%. Now, does that mean that we're going to get back to the GDP level that we were at pre-pandemic in the US? Probably at the end of next year, that's a possibility. but it's not going to be. It depends on a lot of reasons, and it may not necessarily get there um, until the end of the year. We're still going to have a lot of people out of jobs. The non-farm job growth actually dropped. I believe it's going to drop by about 6.5%. It will bounce back, but not as much. And unemployment will remain at a high level. Remember, unemployment was at 4%, pre-pandemic. Now we're at 11% for California and 8% for the U.S. as a whole. This is an average. So average will have 8.8%, and then we're going to drop back to 7.1%, which is still a little bit above what we were at pre-pandemic. And what about California? California job growth is going to be actually slower. We will lose about 13%, this year, but we will only cover it by about 0.5% next year. Now, I hope I'm wrong that we actually will grow a little bit faster, but as of now, that looks like that is the case, and that means we are going to have unemployment at a very high level, average unemployment at a high level at 10.8 this year and a 9% next year. Population will continue to grow, but it's going to grow at a very low level. Now, many of you probably asked me before and maybe asked a question before, if the presidential election is going to make any difference. Typically, based on the past results, if you look at the slide, we analyze election years compared to non-election years. Usually, after when we get into the fall season, people might have already decided, whom they want to vote, and they have already, figured it out. And so, usually, we see the number of the sales growth actually start picking up more so than non-election years. This year, I think we're going to follow a similar trend, not so much because of the election, but more because of the coronavirus pandemic. And I told you before, we are seeing some momentum in sales in California. So sales probably will continue to pick up, or continue to stay elevated for the next few months or so. And because of that reason, it's going to follow a similar trend as the election. But it's not because of the election by itself. So we're going to see some growth in sales, again, not because of election. For home prices, we also analyze election years versus non-election years. Typically, in election years, home prices grow a little bit faster in the fall after or when it gets to close to election. But again, this year, it's going to follow a similar trend. But again, it's probably because of the coronavirus, not so much on the election itself. So safe to say, we are going to see some increase in sales in the next few months or so, and we'll see some growth. And here's our projections for the next few months. The light blue line is what we predicted before a couple months ago, before we actually have more data. But now we have a little bit more data. We're actually changing our projections a little bit. You can see that this darker blue line is actually a little bit more positive compared to this lighter blue line. We are going to see stronger growth in sales for the next few months for October, November, and December compared to before. Same as price. This green bar right next to the solid green were the projection before, and based on the actual numbers, we're actually doing better. So I believe, we made some adjustment to our projections for the next 3 months, which is the blue bar. The blue bars are showing a higher increase than these green bars here. So we do expect a higher number for the next few months for the median price. And because of that reason, here's our forecast. I'll give you the assumptions first, and then I'll give you the actual numbers. We believe the first half of the year, these are based on these assumptions, that we're going to see a vaccine in the first half of the year. We're not going to see a significant surge in COVID-19 cases. We will see some increase, but hopefully not, a significant increase. We're going to see some growth in economic activity next year. We're going to see interest rate remain near 0.1% or maybe below. Very tight inventory continue. And many of you may have asked me questions before, on foreclosed properties. We are going to see some foreclosed properties. We're going to see some increase in foreclosure. There's no doubt about it when it's all said and done. But it's not going to be like what we saw 10 years, 12 years ago in 2018, 2008, 2009. Back then, and I'll show you some numbers. Back then, we have 60% of sales being distressed sales. Now we expect foreclosed sales to be less than 8%. With that in mind, here's the baseline. We're going to see an increase in sales compared to last year, a very slight increase of 0.2%. It's hard to believe that earlier part of the year, we were below by about 15%, 13% or so. Now we're actually projecting that it's going to be up 0.2%. Now this number is going to be different from what you will see in our forecast on the C.A.R. website right now. We will update that number because we made some adjustment as of yesterday, as of last night. So you can say I made this forecast adjustment because of you guys. And we're going to see an increase of 3.3% in 2021 for sales. What about price? Price is actually surging a little bit faster by 11.6% compared to last year, and it's going to increase by 4.4% in 2021. Housing affordability will remain similar, and the 30-year fixed rate is going to be down from 3.2 to 3.1. The reason why I want to clarify that is I know, Kelvin, last week I showed you some different numbers at the public policy forum. This, I believe, is more positive. So hopefully, and it could be even more positive, if things actually start going in the right direction. But of course, things could actually get worse. That's why we call it a baseline, because if for whatever reason we couldn't get a vaccine in the first half of the year, and if we actually have the flu season resurging, then we're going to have too many cases, a lot more cases, and then California will have to shut down. Then we're not going to have any economic growth. And if that's the reason, then even though interest rate is going to stay below 3%, foreclosure is going to start rising significantly. And if that's the case, then we have a worst case scenario. We're going to have a drop in sales for the rest of the year. We're going to see 10% decrease in sales, and then we're going to see some drop off in price in 2021 as well. And that is based on the fact that, let me give you, give me a minute, let me get some water. This is the scenario that I kind of briefly mentioned earlier. 10 years ago or 12 years ago, we have 60% of sales or distressed sales being 60% of all sales being distressed sales, foreclosed REO property short sales. But baseline, we expect a 10% only or 8% only, and price is going to drop by about 10% for those foreclosed or distressed properties. But if we have a worst case scenario, we're going to have 30% of sales being distressed sales, and they're going to be down by compared to market price by 40%. That's going to affect overall prices. Now, I know I am running out of time. I'm going to briefly talk about the new normal, and then I'm going to wrap it up. And then we can have Q&A. The new normal. Okay, so now that we have a short-term projections of what we can expect in the next year or so, what can we expect in the long run? Things have changed. A lot of people are working from home, and so we are actually making a lot of people think of home ownership as more important. So remote working is also more available for people or for employers who allow people to work from home, right? Some of the companies like Facebook and Google, they have already announced that the employees, they don't have to go back to work to their office until next June, maybe even longer. And for us, we have been working from home, so a lot of people may actually want to buy a bigger house. The home is not just about where you rest, but it's also a place where you work. So that's why you need a little bit bigger. And we have seen some numbers based on our survey that people may be looking for bigger places, and some of your clients may be doing the same thing. But also they have different meanings for what a shelter is. Instead of living close to where you work, you don't necessarily have to work 5 minutes away from your house, because you don't have to commute anymore. you can actually move to a bigger area or other areas. Some we have seen, and this is based on our numbers from our MLS numbers, we have seen a lot of people, we have seen some surge in sales, like I said, in Lake Tahoe and Lake Arrowhead, a surge, when I say a surge, 100% increase in sales because people actually are buying homes there because they don't have to worry about traveling 3 hours to where they work because they now can work from home. But a lot of people actually can are looking at home a little differently also. They may actually want to buy a home that doesn't have an open floor plan because we need some privacy when we do our work, right? So the element that they're looking for may be a little different, but also they may be looking for something like a little garden or something. Maybe we need a little bit more room. As I said, um, this I kind of mentioned this already. Some surveys suggest that we actually will have more people working from home. 3/4 of those actually surveys said if they allow to work from home, they will do so. And 2/3 also said, they would actually consider moving if they have the flexibility of working from home after the coronavirus. So this is going to this is going to lead to more people maybe migrating to some of the other more affordable areas as well. So you may actually see, and you might have already seen, some increase in Riverside and San Bernardino because they have more affordable housing there, but also they don't have to worry about commuting and traveling. We also have people who might be interested in second homes. We have done some survey research. Realtors actually noticed that there is an increase in second home. What about on the supply side? With retail sales, or with retail outlet and office spaces being down because not a lot of people may be renewing for office space, and some of the retail may have to be shut down because of the economic situations. We might actually have more retail space and office space opening up, and we may actually end up having those being converted to residential properties. And some of the malls, not just in California, but all over the world, actually have been turned into homes. So some of those malls actually can be turned into apartments or condos. We have already seen that happening, and we have already seen some department store actually filing bankruptcy. J.C. Penney, J. Crew, Neiman Marcus, those have already filed for bankruptcy. And some of the restaurants, unfortunately, might have to close because of not being able to survive. So those could be turned into, the silver lining is those could be turned into residential properties and could increase our supply. So I'm gonna wrap it up with this last slide that shows you, what I've briefly talked about in the last 2 hours or so. The economy is going to bounce back, but it's going to take some time. And it also depends on whether we're going to have additional resurgence in cases. If the coronavirus actually start rising again, it's affecting our lives, then that's a wild card. But for the housing market, we continue to be a bright spot. Sales actually increased significantly in the second half of the year, and we probably will be on par with last year's level. The problem is supply. We have continued to have tight supply. Sellers may have difficulty putting up their properties on the market, partly because they're also buyers, but also because they're concerned about the coronavirus situations. So that is going to put up some pressure on, with tight supply and low rates. We're going to see some pressure on home prices. You will see some increase in prices continue for the last few months of the year. Next year is probably for the first half of the year, but you may actually also notice some dip in price if things started shifting the other way. That is, if we actually started seeing the economy gets better and we started seeing the mix of sales start skewing towards the lower end again. So don't be surprised. Now, as of now, because of traveling restrictions, people are not traveling to the U.S. or in California. That's why you're seeing fewer foreign buyers, and it may actually continue on for the next year or so because we still have a lot of uncertainties about the coronavirus situations. And as I mentioned in the very last few slides, there will be some changes. There will be some long-term changes. Whether people will be, because people are not are able to work from home, they will have more flexibility choosing where they live. They will buy a bigger house probably. The floor plan is going to be a little different, and maybe we'll have some change in the supply as well. And with that said, hopefully I give you a pretty good outlook, or pretty, I shouldn't say good, a pretty complete outlook of where we will be and where we are at right now. And here's where I will be posting the presentation in the speeches and presentation sections. And my address and my email address again is oscarw@car.org. So I don't know how much time we have, but I am open to answer any questions.
Yes, Oscar. Just a couple of questions. How do you see the interest rate going for commercial properties for 2021?
It's really hard to say. I'll have to admit that I'm not an expert in interest rates for commercial properties, but I'll tell you this. If you look at overall situations, yes, depending on what type of property as well. If you look at retail, as I mentioned, retail and office space, they are actually struggling a little bit. So there might be a little bit more risks in that arena, and lenders may be a little bit more reluctant in that sense that they actually may price in a little bit higher in terms of the risk. But at the same time, if you are looking at apartments, if you're looking for investment properties like in industrial space, that might be a little different. Industrial space actually have, as I mentioned, Amazon, a lot of the online places, they need storage. So that actually is not creating as much risk for some of the lenders. So as far as interest rate is concerned, you may be a little bit more, they may be a little bit more willing to lend to people who purchase an industry space. Multifamily or apartment is a little different. Right now, it's a little iffy because a lot of landlords, because of the moratorium is having a bit of a burden on landlords, and it may actually go on for another few months. Who knows what's going to happen next year? The government may extend it, and if the federal government or the state government actually have some policy in place where they will benefit landlords as well, that might be okay. But otherwise, you might actually see landlords or people and investors putting in multifamily actually dumping their property on the market. And if that's the case, that may actually create some risks as well. So that's, I think, you have to think of it in that context when you think about, risks and interest rates.
Thank you. And then another question from a member, with the COVID-19 pandemic, she doesn't see the economy going down, such as housing market and the stock market. With the US GDP on a boom at 33.1% rate in the third quarter, what do you think of that?
Well, I think I mentioned briefly, at the very beginning, yes, we are seeing a third quarter with, significant growth, but keep in mind, we also have a second quarter dropping by 31%. And as I mentioned, even with the 33.1% in the third quarter, we're still, compared to the pre-pandemic level, we're still down by about 3% and 3.5%. So the question is whether we are going to see, momentum in the third and the fourth quarter. The fourth quarter is very questionable, though, because of many different reasons. The fourth quarter, remember, in the third quarter, we started seeing increase in retail sales because we're getting a lot of people who are unemployed are actually getting federal assistance. Right now, we don't have a stimulus package. The stimulus package is probably not going to happen until maybe end of this year or next year. So for the next few months, a lot of people actually are missing that federal assistance. And so the fourth quarter numbers probably will be weaker than we thought. Now, it's still going to be a growth probably, but it's going to grow by about 4 or 5% rather than a double digit. It may even grow at a 3%. I think many economists believe that it's going to be a weaker number compared to before. So for the year as a whole, we definitely will be. If you ask me, I'm pretty certain that we'll be down from last year. For 2021, yes, it's going to be a growth, but it also depends on whether we are going to see a vaccine or whether it's going to be that we're going to see a stimulus. If we see a stimulus, the economy is going to be better, and the housing market, I can tell you, the housing market is going to be better than this year. It might not be significantly better, but it's going to be better in terms of sales and probably in terms of price as well.
Thank you, Oscar. Thank you, everyone. This wraps up our presentation. Thank you, Oscar, and everyone, have a good day.
Thank you very much. And I'm very happy that I was able to deliver some insights to you guys. And again, if you have any questions, feel free to send me an email, or you can download the presentation on the C.A.R. website as well. Thank you.
Thank you.